Chris Whalen is going to join us right now, chairman of Whalen Global Advisors. We can talk about Jamie's presidential potential in the future, but your read on the letter and what it means specifically to J.P. Morgan, the bank, and the banking industry for now.
Well, Andrew, the letter doesn't talk very much about the bank. I wish he would spend more time on the business and less time on public policy. I'd love to see Jamie run for president. I've said that before.
44 pages,
not
Chris.
sure which party, but
the whole top of the letter is about the bank.
The letter is milquetoast.
Yeah, the whole top of the letter is about the bank. The 44 pages, you can get into some other ground. It's much longer than what most CEOs write about for their annual letter.
Yes, it is. Yes, it is. I would be more interested to hear him talk about the environment and particularly how the unwind of the Fed's market manipulation is going to affect banks. As you guys know, I've been concerned that the good times are behind us in terms of the subsidy that the Fed has provided to the industry. And now I think as deposit rates go up, as bond yields go up, and that subsidy ebbs, it's going to be much harder for banks to maintain profits, much less grow them.
Oh, see, I thought he took the other side of that. I thought he was saying he thought that this unwind was working. No?
I think his take on it is that
that's the party line.
Surprise people.
You know,
but otherwise
everybody is saying that, but they don't want to acknowledge how unusual and how extraordinary this period was. I mean, even last quarter, all U.S. banks, $17 trillion worth of assets, paid $20 billion to depositors and bondholders. Normally, that number would be close to $60 billion. And by the way, that encompasses all of the industry's earnings. So essentially, the subsidy from low interest rates that's funding these banks accounts for almost all of the industry's operating income. And I think over time, as that normalizes, you're going to see a much more different picture than you see today. Because the industry in 2015, they paid $11 billion for all of the funding that they took. That's extraordinary.
Chris, two sort of numbers-based questions that came up. One, he seems, if there is excess capital, pretty committed to still doing buybacks despite the share price appreciation instead of dividends. What's your view on that? And secondly, there's an interesting segment, which he's brought up recently at the Investor Day as well, about forward guidance and potentially wanting to do away with having to give detailed forecasts each quarter. What do you think the analyst community would say to that if they did scrap that kind of thing?
I have never been a big fan of guidance. I'd rather focus the analyst community on actual results. I think guidance is what it is. It's speculation. In terms of the capital, obviously, U.S. banks are overcapitalized. They are making less money on more assets and more capital than they were 10 years ago. And I think over time, we have to look at this because we do want them to take risk. And they're not doing that right now. The risk is in the non-bank sector, which is funded by the banks. But the banks themselves are not stepping out of that safe box. The regulators have told them no headline risk, no credit risk. And that's the policy they're following.
At 2 times book value or whatever it is at the moment, if he's still committing to buying back the shares as opposed to paying a dividend, is that a very bullish signal for the stock price, at least in the chairman and CEO's eyes?
Well, they're closer to 1.6 right now after the sell-off. In February, they were close to 2. They have to buy back shares. That's the quid pro quo. The street has predicated their support for these large cap stocks in all industries on share repurchases. So I think that's going to continue, but they're buying it at a very dear valuation. I think, Wilfred, that's your point. The pricing is toppy. And it's going to remain that way because investors don't have many choices. They focus on large caps for liquidity. And, the top 10 names in financials are all you guys ever focus on. You don't talk about smaller names, which is where the value is.
I do have one question. Is there any, right now, J.P. Morgan is clearly at the top of the heap. Is there any bank you see on the horizon that you think of as a true competitor to what they're doing? I mean, there was just a report yesterday that Goldman Sachs wants to get in the commercial banking business. That may very well be, but I don't know if it's going to take some time for them to get to a place.
Well, Goldman is so small. They are taking baby steps in that direction, which I think is a good idea for them. They do need to grow their bank. They need to grow their funding base, which is very small. Their bank's only $180 billion. It's a small bank.
What about Bank of America?
They would be better off buying a bank than trying to grow it, honestly.
Becky was just asking briefly about Bank of America on a relative basis to JP.
Look, they great story last year, but I think, again, where is the juice going to come in that stock? More cost savings. Not going to see a lot of revenue growth. It was a cost-cutting story last year. The stock led the way. I mean, it was up mid-double digits for the year. And most of these stocks are still up. I mean, look at JP. They haven't really given up that much ground. They were up 30% back in February, year over year. So to me, it's not like these stocks are going to plummet. No, that's not the case. But I think the valuations we saw back in February were not supported by the fundamentals.
But Becky,
that's the real point.
You've got to give a round of applause to Moynihan and Bank of America as well. 300 billion market cap now to JP Morgan's 400 or so still in the lead. But what you'd say in general, the US banks are the Goliaths now versus the rest of the world. Citi, you'd throw in as a challenger there,
equity returns are 30% below where they were a decade ago. That's it.
Chris, we got to leave the conversation there. We appreciate it.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.